Buy low, sell high. In other words, you want to buy at a market bottom and sell at a market top. This is a market bottom as identified by this indicator. Let's take a buy and see what happens. Place a stop loss under the channel of the indicator. Target a 1 to 1.5 risk-reward ratio. Let the trade run, and it was profitable. Now, here was a market top, which means we're supposed to open a short position. Stop loss above the upper channel. Take profit at 1.5 times the risk. Let the trade run, and as you can see, the trade was profitable. Ladies and gentlemen, this is the Top G indicator by Big Beluga. It's a tool designed to identify market tops and bottoms, helping you to spot trend reversals with ease. In this video, we're going to go over what this indicator is and how you can use it in your trading. If you hope and find value in this video, remember to leave a like. Let's get into it. Now, to add this indicator to your chart, you want to go to Trading View and then open any trading security that you like in any time frame. For me, I'm going to be using the 15-minute time frame of CAD CHF. Next, you want to click on Indicator and type in Top G, and you want to select this one called Top G Indicator by Big Beluga. Now, you may be thinking, but what exactly is this indicator? Well, the Top G Indicator by Big Beluga is a technical analysis tool designed to assist traders in identifying potential market tops and bottoms. Its simplicity and focus on market extremes makes it particularly useful for traders looking to time entries and exits in trending or ranging markets. As you can see, it's a super simple indicator, which is made up of the following components. First of all, we have the trend channel. At the top of the channel, we have the upper band, and then at the bottom, we have the lower band. Then at the center of it, we have the midline. These bands serve as key reference points for analyzing price movements. They can be used to identify potential areas of support and resistance, helping traders to decide whether to enter or exit trades with greater confidence. When the price approaches the upper band, it may indicate overbought conditions and a potential reversal or resistance zone. Conversely, the lower band signals oversold conditions and potential support. The midline serves as a dynamic equilibrium, helping traders gauge whether the market is strongly trending or consolidating within a range. Now, the main components of this indicator are the top and bottom labels. This is the top label, and this is the bottom label. Whenever you see this, it basically means that the market is likely reaching a high probability top or an overbought zone. It signals a potential reversal to the downside, making it a good point to consider exiting long positions or entering short positions. This label is based on price action dynamics that indicate market exhaustion or resistance. On the other hand, at the bottom, we have the bottom label marked with the G sign. This indicates a high probability bottom or an oversold zone. It signals a potential reversal to the upside, making it an ideal point to consider entering long positions or closing short positions. This label reflects conditions like low volatility or momentum shifts, suggesting that the market may be preparing for a rebound. And then we have this caret and this inverted caret. These are called intermediate signals. This one indicates potential bottom areas, but with less certainty than the G labels. These are secondary signals, useful for traders monitoring for reversal opportunities. On the other hand, this signal identifies a potential top area, but again, with less certainty than the top label, providing additional context for traders who are trading in range-bound markets. Now, how can we use this indicator to trade? Well, I'm going to tell you, but before we do that, let's take a look at the settings of it and see how customizable it can be. On the Inputs tab, we have the length with a default value of 150. This determines the number of bars. For me, I'm going to change it to this bright pink for better visibility. The length is going to remain at 150, and then on the Style tab, I'm going to disable the midline for a cleaner look. After that, click OK. Next, let's add the MACD indicator so we can cross-check the strategy. Double-click on it so we can open the settings. On the Style tab, you want to disable the MACD line as well as the signal line options. After that, Click OK. Now that we've set everything up, let's go over the conditions for taking positions. Now, the idea behind this strategy is to use the top G indicator to identify market tops and bottoms. Now, before we take positions at these tops and bottoms, we will look for divergences on the MACD indicator as extra confluence. Now, for a long position, you first of all want to identify a bullish divergence on the MACD. This unique type of divergence requires three things. First, you want to look for your initial MACD low forming a clear trough, and then let the MACD histogram move upward and create several green bars. After that, the histogram must form another MACD low with a series of red bars. You want to ensure that the first MACD low is lower than the second MACD low, confirming a bullish divergence. Now, on the chart, you want to draw a line from the middle of the first MACD low to the middle of the second MACD low, and compare this to the price. If the price creates lower lows while the MACD shows higher lows, this indicates a divergence, 200. Now, within the divergence, you want to look for a G label, signaling a potential market bottom and further increasing the odds of an upward move. Now, once you see the MACD histogram turn green again, indicating bullish momentum, you enter a long position. Place your stop loss right under the lower band. Set your take profit 2 times the risk. Let the trade run. And in this example, it turned out profitable. Ding! Now, how do we take a short position? Well, it's going to be the opposite of what we did here. Now, condition number 1 is you want to identify a bearish divergence. Here, as you can see, I've drawn it, and this is the explanation. The MACD created 2 highs with 1 low in between. The first high was higher than the second high, which means while the price was creating a higher high, the MACD was creating a lower high, giving us a divergence. Looking at this, we can see it's the exact mirror opposite of the bullish divergence that we used for the long position. Once we have the divergence, we need to mark the beginning of it all the way to the end of it. And then in between these 2 lines, we need to look at the price and see if there is at least one top label printed. Right here, we can see that we have multiple top labels printed, indicating that the price may be overbought and due for a bearish reversal. Once this is confirmed, we just wait for the MACD histogram to shift to red to signal an increase in bearish momentum. We take a short position. Stop loss above the upper band. The take profit is going to be set at 2 times the risk. Let the trade run. And as you can see, it was profitable. In summary, the top G indicator by Big Beluga identifies